with us, who is a business developer of Directed IRA. They are based out of Phoenix. And Jeff and I actually connected about six to 8 months ago at a local event here in Phoenix. So super excited to have him on. And today he's going to talk about the powerful vehicle of self-directed IRAs as well as solo 401ks. And these can be extremely powerful vehicles in investing in alternative investments. Now, with us being a real estate investment company focused on multifamily, we're going to be focusing more so on that and how those vehicles can help you build your retirement and get to that financial freedom a little bit closer. So these are great vehicles for people that might not be impressed with the stock market or looking to pull out and to get into alternative investments. So without further ado, I'd like to welcome Jeff. Jeff, thanks for being with us this morning.
Yes, Dylan, thanks for having me. Happy to be here and happy to share some knowledge on self-directed IRAs with everyone.
Excellent. Well, why don't you go ahead and just give us a little bit about your background and what got you into this space, and then we'll just go from there.
Sure. Yeah. So I've been in the self-directed IRA industry for the past 10 plus years. I originally grew up and lived in Cleveland, Ohio, and worked for the largest self-directed IRA custodian in the country, Equity Trust. They're based right there in Westlake, Ohio. I had a good friend that took a position working with Equity Trust. He was telling me what he was working on, helping people buy real estate and then selling it tax-free in a Roth IRA. So that was something I never heard of before, but it intrigued me. So shortly thereafter, I was employed with Equity Trust and on my journey to learning about self-directed accounts and self-directed investments. I've since worked for Provident Trust Group and now work currently as the Director of Business Development here for Directed Trust Company or Directed IRA. And we are founded by Matt Sorensen and Mark Kohler. If you've read the Self-Directed IRA Handbook, the best-selling book on our industry, Matt Sorensen is the author. So he's a kind of guru, if you will, in our space. When I heard that Matt had a trust company and started his own trust company here right in my backyard in Phoenix after I had moved out here, I kind of jumped at the opportunity to work with Matt. And I'm happy to share my knowledge of self-directed IRAs. I always tell everyone I speak with, there's no retirement 101 class that they teach you in school. So it's really on you to seek out this information, do the research. So kudos to everyone for joining today and learning a little bit more about these different retirement accounts and the different ways you can invest. It's not common knowledge, and happy to share it with everyone.
Jeff, you brought up an excellent point. This stuff isn't common knowledge and it's not taught in the school system. And so that's really what drives these webinars. That's really what drives who we are at Rev. There's just not enough of this information out there. And there's often so many better ways to create wealth, to build your retirement, but you don't know what you don't know. And so again, super grateful to have you on. Thanks for sharing that background. So I believe you said you had a presentation for us. So I'll let you take it. I'll let you take it from here, and we'll just get going.
Excellent. Yeah, would love to share some slides and a presentation I put together. There's a ton of content I'm going to cover today. So if there are questions, feel free to put them in the chat. Try to address as many of those as possible. And then if you have more specific questions, something about your own personal situation, we can always schedule a call after this webinar and talk one-on-one. So happy to be a resource even after this webinar today.
Excellent. And you should have permissions to share.
All right. So hopefully everybody can see our screen here. What we're going to be talking about today is self-directed IRAs and self-directed solo 401k plans.
I don't know if it's just me. I'm not seeing any slides. Anyone else?
Oh.
There
we go.
Is. All right.
Now we're ready to go. Let's go. All right. So what we'll be talking about is investing in apartments and other real estate, other alternative assets through a self-directed IRA or a self-directed solo 401k account. Now, I did mention Matt Sorensen our CEO and founder. He's a tax attorney, so this is a very important slide Matt would want me to cover. Basically, everything we're going to talk about today is for educational purposes. Doesn't, supplant the need to talk to a professional like an attorney, accountant, or financial professional when it comes to investing. But hopefully we'll give you some great information that you can utilize for your own retirement accounts. Kind of covered a lot of this just a few minutes ago. One thing I will mention, in our industry, we're not financial advisors. We have certifications. The Retirement Industry Trust Association, RITA, I have a certification that held with them, and also a CIP designation. So that's a certified IRA professional, kind of the gold standard of the certifications that we can receive, in this position, working in the self-directed IRA industry. At the end of the day, these accounts are self-directed. So what does that mean? You yourself are going to kind of make the investment decisions, do the due diligence, and decide if these investments are the right fit and good investments for you. But we can help educate you on how these accounts work and the rules that you have to kind of follow when you're investing with these self-directed IRAs. So why are we talking about retirement accounts today when it comes to investments in real estate? I've got 33 reasons why, 33 trillion reasons. This is the amount of capital that is in retirement plans in the United States. So this is the largest source of capital. If you're looking to raise money for a real estate project and you're not considering retirement accounts, you're really doing yourself a disservice. Now you'll see here towards 2021, these numbers start to taper off, and that's likely because of the downturn in the market. So another great benefit of a self-directed IRA is you're not tied to the market. You have the ability to invest in things outside of it. So these properties that you're investing into, they're not tied or correlated to the market. A self-directed IRA is a great way to provide diversification to your portfolio. Regardless of what's happening with stocks and bonds and mutual funds, you could also hold assets into private companies, notes, real estate. We'll talk about all those today. They're not tied or correlated to the market. So oftentimes it's a great way to diversify your portfolio and kind of minimize that risk that you're associated with perhaps when you're in the market. I think it's important that we cover what a self-directed IRA is. That term self-directed, really describes the retirement account. So you'll hear me use self-directed IRA, self-directed 401k kind of interchangeably. Just realize these are two different types of retirement plans. There are traditional IRAs, Roth IRAs, SEP IRAs, health savings accounts, Coverdell education savings accounts, solo 401k plans, all of these different account types that we offer that are essentially ways to save money for either your retirement, your healthcare expenses, educational expenses. They can all be self-directed, meaning that you are going to make the investment decisions. So I sometimes have clients that come to me and say, well, I want the self-directed account. I just tell them they're all self-directed. We just need to figure out what account type matches the type of retirement funds you have currently, and make sure that that tax environment is compatible. So if you're looking to establish a self-directed IRA, you need to work with the custodian that allows you to invest in real estate and these other alternative assets. And that's really where directed IRA comes in. Many clients are used to having a retirement account at a place like Fidelity or TD Ameritrade, maybe a credit union or a small bank. That's where their retirement accounts are. And those custodians or those institutions, they may not allow you to invest into real estate or alternatives. It's not that they can't, it's that they choose not to. There's more of an administrative burden when you're investing into these private or alternative assets. And that's why the larger firms like Fidelity, Vanguard, Schwab, they may not have the ability to, they may not have an account that gives you the ability to invest in these assets. So oftentimes what we're helping clients with is taking an existing retirement account like an IRA or 401k plan, and then moving that into an account with directed IRA. So a directed IRA, we allow clients to invest in any investment allowed by law. There's a couple of things that the IRS says you can't invest into, like S corporation stock, life insurance contracts, certain collectibles like artwork, alcoholic beverages, firearms. But outside of that, you can get very creative. We'll demonstrate here just some of the many different types of investments that we hold for clients in their self-directed accounts. One caveat I'll say here, I did have a client just recently said, Jeff, loved our conversation we had about self-directed IRAs. I actually spoke with Fidelity. They have a self-directed account, so I'm just going to keep my account there. The issue was when they went to go buy real estate with that account, Fidelity told them, oh, well, it's self-directed. You can choose your own stocks, your own bonds, your own mutual funds. That's what we have on our menu, and that's what you could choose from. But if you want to hold real estate, that's not something we hold due to that administrative burden. So ultimately, that client ended up having to move their account to directed. And luckily, they were able to do it in time before their closing deadline so they could purchase their real estate.
Now that seems kind of sneaky in my mind, Jeff, and correct me if I'm wrong, but was our companies like Fidelity picking up on this? So they're calling it a self-directed IRA just to try to keep their clients, but it's not at all the same thing. Is that what they're doing here?
It is. And I think sometimes it's just, they're not aware of what the client ultimately is looking to accomplish. The client may come to them and say they're looking for a self-directed option, but they're not mentioning that they want to eventually use it to invest into real estate. So it's that investment that you're making that really dictates if you can use an account at that financial institution for your goal and what you're looking to accomplish. And let's be honest, those companies, they want to keep those assets under management. That's how they charge fees and make money. So I do think there's a little bit of gamesmanship there. We have a self-directed option, but really it's not what we're looking for if you're looking to do real estate, notes, crypto, other private or alternative assets. A little background on directed IRA. We're a licensed and regulated trust company, and that's an important distinction in our space. There are some companies that are third-party administrators that actually outsource the custodial duties to a true custodian. So I know if it's my own personal retirement account or my friends and family, I want to make sure that I'm working directly with the custodian. We are audited, we're examined, we have, certain insurance, certain capital requirements. It's a big deal to be a trust company. And you can see here, we've got our license number, very transparent about that. Basically what this information here represents is that, we're an audited financial institution. So you can feel safe holding your retirement funds with a licensed regulated trust company based here in the state of Arizona. You'll see, got a couple of pictures of Matt Sorensen and Mark Kohler, our CEO and CFO and founders here, experts in the space, been working with self-directed accounts for 15 plus years. Create a ton of content, educational content on self-directed accounts and how to invest in these assets. And really are kind of, as I mentioned, gurus within the industry. A big reason why I chose to come and work with them. And I think a big reason why our clients are transferring or moving their accounts here. They want to work with the experts in the space. And that's exactly what Mark and Matt represent. Our vision statement here is to be the leader in the self-directed retirement industry. And we want to provide investment capability with unmatched expertise, professionalism, and care. I think when you look at the self-directed IRA industry, there are some competitors where their customer service can be somewhat lacking, and that's something that we wanted to rectify here. We saw that as kind of a deficiency in the industry as a whole. When you're self-directing your retirement account, it's not often you move retirement funds around, especially between financial institutions. And then when you're making alternative investments, this may be the very first time you're doing that. So you generally want some support, some hand-holding. You want to make sure you're doing things correctly. If you have questions, you want to be able to actually speak with someone. And that's where we kind of hang our hat and pride ourselves on our service that we provide here. You can view our reviews on Google. They're all 5-star verified Google reviews. So those are real clients, real individuals talking about their experience with directed IRA. At the end of the day, we want to make sure that, sure, we provide the product at a great price, but we're also there for the support. So a big proponent of making sure that we're available to answer your calls, respond to you in a timely fashion, but also in process your investments quickly. Oftentimes these real estate investments, they're time sensitive. We do want to make sure that we're doing things correctly. We have to follow certain guidelines. So anything we can do to help make sure that process is done quickly, smoothly, efficiently, that's our goal here at Directed IRA. I love this slide here because this picture talks about some of the different investments that can be made with the self-directed IRA. So you'll see these different puzzle pieces. Only one says real estate, but really I would say all of these different puzzle pieces could be related or tied into real estate. Bitcoin and crypto, they're tokenizing real estate, and that can be invested on the blockchain now. Small businesses and startups, perhaps that's a small business that's being set up to, invest in rental properties. Checkbook IRA LLC, that's a structure we'll get into a little bit later to allow you to have checkbook control over your qualified funds, manage your rental properties or your real estate deals more efficiently. And then you also see here promissory notes and lending. Another big asset that we hold for clients is actually lending on real estate projects. So you may not be the owner of that property, but you could lend on someone else's project and generate a return for your retirement account that way. So we'll get into that as well and give an example of that here shortly. Why would a real estate investor want to use a self-directed retirement plan to invest in real estate? There's a number of different reasons here. That's where their money is. If you think about it, where is the majority of your savings? It's probably not in your checking or your savings account. It's more than likely in your IRAs, your 401ks, those employer-sponsored plans that you have through work. Being able to tap into that money and use it for these deals to provide capital to fund your real estate investments and ventures, it makes a lot of sense for real estate investors to do so. A lot of times these real estate investors, this is what they know and this is what they understand. So they trust real estate over the stock market. We have a trademark here. It says invest in what you know. And a self-directed IRA is the vehicle to allow you to do that. If I have a self-directed account, I can invest in real estate since I'm a real estate professional. And that's what I know and I love and I use. Dallin, could you tell me a mutual fund or a stock that you're really excited to invest into with your retirement account?
No comment, Jeff.
Exactly. So I think, we've been trained to, put your money in the markets. That's what you're supposed to do. I think looking at your retirement account through a different lens, being able to have control over that, invest in something that you're more confident in, something that excites you and interests you, that to me makes a lot of sense. So that's what we find. A lot of our clients, they're already real estate investors. They're doing deals personally. And this is a great way to apply that same knowledge to their retirement account. Maybe they'll generate a better return. With the market and the volatility we've seen recently, a lot of our clients are explaining to me that they're extremely happy with their decision to set up a self-directed account and diversify into some of these other assets. Just had a client this week saying that, regardless of what's happening in the market, the rental property in their Roth IRA is still generating positive cash flow, building their account each month. So self-directed account, may generate even greater returns than what you're typically getting in the market. And then also these self-directed retirement vehicles, they allow you to grow your wealth either tax deferred or potentially tax free. We're big proponents of the Roth IRA account. Where else can you grow money and build wealth tax free? When you're investing in real estate with a tax-free Roth IRA, there's no taxes on the gains or the income that's generated. So it's a very powerful tool to be able to have that tax-free growth compounding in a Roth IRA or the Roth component of a solo 401k plan. I alluded to, in that puzzle piece, there are different types of real estate, that you can invest into. So give some examples quickly here. Rentals could be single family, multifamily, commercial, retail properties, private offerings like syndications or partnerships. Perhaps there's a syndication to develop an apartment complex, and you want to invest with your self-directed account. You could subscribe to that investment with your IRA, and any returns generated, remain tax sheltered back to the retirement account. Really, any property type. This could be land, rental, leases, flips, rehabs, liens, water rights, mineral rights. There's tons of different ways to be able to invest into real estate. And again, invest in what you know. You may not be experts in water rights or mineral rights, but it's possible if you are to invest in those types of assets with your retirement account. Now, there are some rules, and an important distinction here is you cannot buy a personal residence. So unfortunately, you can't buy that vacation home in Hawaii and with your IRA and then stay in it and use it personally. There are some rules against that. There's also some rules against certain family members, parents, grandparents, children, grandchildren, not being able to use your IRA-owned properties. So we'll get into those rules a little bit further. But just realize when we say real estate, you can really be creative within that real estate kind of realm, investing in all of these different types of assets. So this slide here, this does just a high-level overview of what a self-directed IRA investing in real estate would look like. So you'll see down here at the bottom, we have the IRA owner that set up a self-directed account here, this piggy bank. The IRA is actually going to take title to the property. So that's an important distinction. You and your IRA are not one and the same. They're separate from each other. So it's not you buying the property, it's your IRA. So the IRA in this example here is going to take title to the property. The IRA is going to pay for all the expenses, acquiring that property, paying the property taxes, paying the utility bills, paying the contractors to do work, furnishing the property. It all gets paid for out of the IRA. And then any of the profit that's generated flows back to that IRA account. So that could be the rental income the tenant's paying, could be proceeds from the sale of the property. That all goes tax sheltered back into the account. Eventually, you as the IRA owner can take distributions once you hit legal retirement age, 59 and a half, and start benefiting from the growth that you've been generating in that retirement account. In this example here, we're talking about the IRA, again, buying property directly. When you're buying the property, I mentioned the IRA takes title. So this property isn't going to be owned by Jeff Minnick. If I'm using my self-directed IRA, it's going to be owned by Directed IRA, FBO for benefit of Jeff Minnick's Roth IRA. So it's clearly demonstrating that, Directed IRA is the custodian for the account. The account is for my benefit, but it's the Roth IRA that's making the ownership or taking title to the property here. So the self-directed retirement plan is going to own the property. It receives the income, pays all the expenses. You as the IRA owner, you can't do any work on the property yourself. So we'll get into that when we get into the rules here. Can't do any of the sweat equity. And in this structure here, the account is taking ownership of the property directly without any LLC or without any other kind of structure in between. This can be somewhat cumbersome because anytime there's an expense, you have to request funds from your custodian to pay for that expense, send the money to the contractor or to the utility company, whatever it may be, to pay for that. So we'll actually go over an IRA LLC structure here in a little bit that's going to allow you to have a little bit more control over that. I talked about maybe your account balance isn't sufficient to invest and buy property outright, but you could perhaps loan on someone else's project. Think about hard money lenders and the terms that they sometimes dictate and generate. Your self-directed account could be that hard money lender. So in this example here, your self-directed account is actually going to loan money. So you'll draft up a promissory note. That note could be secured, it could be unsecured. But you kind of dictate the terms between your IRA and that third-party borrower. Again, can't be yourself or certain family members, that would be disqualified. But if it's an unrelated third party, somebody non-disqualified, your IRA could loan capital to that third party. Perhaps they use that to actually go out, maybe acquire real estate. So your loan could be secured with that real estate as collateral. And now they make interest payments back to your retirement account. It's a great way to drive passive interest payments back to the account, dictate that rate of return. And again, these terms, it's up to you and the borrower to agree upon. So if you want to charge, 8, 9, 10% interest, you want to charge points, that's completely up to you to agree upon. So you can really be kind of creative, and the promissory note investments, note investing gives you a lot of flexibility. We also have clients that are buying notes at a discount. They're not generating these new notes or paper. They're buying existing notes or paper, maybe getting those to perform again and generating returns there. So note investing, another large asset class that we hold for accounts here. So it's not just buying properties directly, it could be loaning on other people's real estate projects. Those rules that I've been alluding to. So what can't an IRA invest into and who can't an IRA transact with? I kind of covered these earlier. The things that the IRA can't invest into: collectibles like art, alcoholic beverages, stamps. Our CEO loves to tell a joke about, investors that were investing in wine collections. Those wine collections were quickly becoming bottle collections. So the account owner was, let's say, partaking in some of the wine that they had invested into. They're using it for their personal benefit. That was a prohibited transaction. So IRS has given us some guidance on that. But life insurance, S corporation stock, those are the other examples. The IRS has clearly stated, these aren't good investments, can't be held in an IRA. Outside of that, though, you can get really creative. Now, who can an IRA not transact with? There's a group of disqualified persons that the IRA cannot transact with. And they purposely use that word transact because that can cover a lot of things. That could be buy from, sell to, lease to, rent to. So transact, can cover a lot of different types of transactions that could be made with different third parties. This is a great chart. I think it clearly demonstrates the disqualified parties here. You'll see in red, it's the IRA owner. So your IRA cannot transact with yourself. If you own a property personally right now, unfortunately, there's no way to sell it or assign it to your IRA. Even if you're trying to sell it to your IRA at market value, IRS doesn't want you giving your retirement account a sweetheart deal, and maybe stuffing that value in the tax shelter of your retirement account. Again, can't buy a vacation house for yourself. And then also up and down the family tree here. So parents, grandparents, children, grandchildren, your spouse, those are considered disqualified parties. You'll see here in green, your brothers, sisters, aunts, uncles, nieces, nephews, even your in-laws, father-in-law, mother-in-law, they're not considered disqualified. Your son and daughter-in-law, different story, they are considered disqualified, but other distant family, they are not. So basically what this chart is demonstrating is these are the people that your IRA can transact with, and these are the individuals that your IRA cannot transact with. Over here on the right, I've got a disqualified company. So we sometimes have IRA accounts. They're not dealing with individuals directly, but they may be investing in other people's businesses. If that is an existing business, they're going to look at the ownership percentage. If that business is 50% owned by disqualified persons, it's not going to be able to transact with your self-directed IRA account. So if you own a business, 100% owner, and you wanted to buy a property in your IRA, rent it out to your business to use that space, that would be a prohibited transaction, unfortunately. Some other common prohibited transactions that we see, just give a few examples here. Let's say the IRA owner wanted to buy a rental home, and then they wanted to stay at that property, and vacation there. Unfortunately, that's not a good fit for the IRA. That's prohibited. We have renting to certain relatives. Had a client that wanted to buy a rental property in a college town. They were going to rent it out to third parties, but their daughter was also looking to stay at the property and basically use it rent-free. That was going to be prohibited. So they could rent it to third parties, but their daughter couldn't stay there and use the property. If you're handy, you do some of the renovation work on your properties. You don't want to do that if it's an IRA-owned asset. You always want to hire a third party. Doesn't have to be a licensed contractor or something like that. You could absolutely hire, a handyman or a friend to do some work on the property. But it's best that the IRA pay for that expense, hire that third party to do any work on the property. I get questions on this a lot of times where clients will say, well, how would the IRS know if I, maybe did some landscaping or painted the walls inside my rental property? I can't tell you how it's policed. I can just say that if you get caught doing that, the penalty is severe enough, I think, to deter you from doing it. The IRA could become distributed because you engaged in a prohibited transaction. So really not worth it to do any work on the property. Best for the IRA to pay for that and hire a third party to do that. Another common prohibited transaction we see when it comes to doing some renovation work is paying for those repairs or paying for those expenses out of pocket. rather than going back to your IRA, obtaining the necessary capital to pay for that expense, you just cover it with your own, cash, your own credit, debit card. That would be commingling your personal funds and your retirement funds. So you never want to do that. Always make sure that if there is an expense related to an IRA asset, the IRA account is the one actually paying for it. This is my favorite slide of the whole presentation here. So we're going to go over the IRA LLC structure. You'll often you hear this referred to in the industry as having checkbook control over your IRA. And I love this structure for individuals that are going to be doing real estate investments like flips or investments into rental properties, because it really gives you even more control. So in this example here, you'll see the self-directed IRA account that's been established. It is first going to take ownership in an LLC that's been created. Now, we have a great resource for setting up this LLC properly. KKOS Lawyers, or Matt Sorensen and Mark Kohler are partners. They've set up tens of thousands of these LLCs. You don't have to work with them. You can work with any reputable attorney that you choose. But this LLC is not something you're going to want to set up on LegalZoom. There's certain provisions that need to be included in your operating agreement. So you want to make sure that's set up properly. But we have a great resource for that. In this example, though, the self-directed IRA is first going to take ownership in the LLC. So if you were to look at your IRA statement, it's made an investment in a private company. Now, this LLC, the member of the LLC is your self-directed retirement account. You, as the owner of that account, can also be the manager of the LLC. That LLC will have its own business checking account, and you can manage that checking account. Now, the LLC can actually take title to property. So rather than directed IRA, FBO for benefit of, Jeff Minnick Roth IRA, let's just say this LLC is called XYZ LLC. XYZ LLC is on title as the owner of the property. So it adds an additional layer of kind of liability protection here by using this structure. The LLC would now pay for all of the expenses related to that property, and you have your own checking account to more efficiently manage that. That first example we talked about, if you had an expense, you'd have to come back to your IRA custodian, likely provide an invoice on what that expense was related to, request funds, and wait for us to send out money. In this example, the qualified funds have already been sent to the LLC's bank account. So there's typically excess funds in that LLC bank account to cover, ongoing expenses and manage this property. So the LLC, if it needed to pay an expense, you could write the check. This LLC could also have its own debit card. Can't have a credit card, can't extend credit to your IRA, but you could set up a debit card and use that to pay expenses. This is also much more efficient when you're collecting rent. Your tenants can make their rent checks payable to that LLC, instantly when that money has hit your LLC's bank account. So it just allows you to much more efficiently manage the rental properties or fix and flips. Imagine if you had to pay contractors, to do work on a fix and flip project. They want to get paid as quickly as possible, rather than waiting for your IRA custodian to send a check or send funds. You could issue a check on the spot. So it's really an excellent structure, depending on the sort of investment you're making. If I'm investing in a real estate syndication, maybe it's a bit more passive. I may not need this structure. But for investments into rental properties and fix and flips, it's an excellent structure to have in place. I would also say this example, we're talking about having a checkbook LLC to invest in a rental property. Let's remove IRA LLC right here. And let's just say this was a syndication. Let's say this was just an LLC, not an IRA LLC, that was in place to develop an apartment complex. So if I'm investing in a syndication, it's a very similar workflow here. I've got my self-directed IRA. I invest in the syndication. The syndication then uses that capital it's raised to acquire real estate and then pays a return back to the self-directed IRA account.
Now, just to clarify, Jeff, when you say like working on a flip property, this can't be your own flip property, correct?
That's correct. So again, if it's a flip, your IRA could purchase that property. Your IRA could pay third-party contractors to do the work on the property to renovate it and then sell it. But again, you personally couldn't do the work yourself on that fix and flip. in this example here, I just want to hit on this quickly as well. We talked about a single member IRA LLC where there was just one retirement account that owned the LLC. In this example here, you're pooling money from multiple sources. So this could be two self-directed IRAs. Maybe you have a combination of traditional IRA and Roth IRA, or maybe it's you and your spouse, each with self-directed IRAs. And, alone, you wouldn't be able to maybe do a transaction, but if you pooled money together, maybe that gives you enough capital to do your deal. This structure is used exactly for that purpose. So I know here it's talking about two self-directed IRAs. This could be other sources of capital, though. Imagine if you were investing in a apartment complex and you wanted to raise capital. Some investors maybe wanted to use their self-directed IRA accounts. Some investors maybe wanted to invest personally in their own personal name. Others maybe have an LLC that they're using and want to use that LLC to kind of invest in this project. So those different sources can all pool money into a multi-member IRA LLC. And again, that LLC can then go out, acquire a property, pay expenses, collect the rent, and then eventually money would flow back to the owners of that LLC, these individual sources of capital. I use the analogy, everyone jumps in the pool at the same time. So when you're setting up this structure, again, it's a newly formed IRA LLC. All of these different sources of capital are going to contribute money to that IRA LLC and capitalize it at the same time. The dollars contributed are going to determine the ownership percentage. And that will also determine the percentage of returns that flow back to those owners. So in an easy example, let's just say it was a 50-50 split here between these two self-directed IRAs. Once there's profit generated from this rental property over here, that profit would flow back to these self-directed accounts on a pro rata basis. So 50-50 on the returns here. If there were three sources of capital here, maybe they were each a third, then returns on investment would eventually flow back, 33.3%. So it's going to determine, kind of the returns on investment and how that's dictated going forward based on those initial dollars contributed. Important distinction here, a single member LLC, it's considered a disregarded entity for tax purposes. It's owned by a retirement account, which itself is a tax sheltered account. So there's no tax return that needs to be filed for a single member IRA LLC. When you have a multi-member IRA LLC, it's considered a limited partnership. So it does have to file a limited partnership tax return, a 1065. And again, we have resources to help with that if needed. We've been talking about buying real estate or investing into assets when you have enough capital, in the account itself. But you can also use leverage when you're investing in real estate. Now, in this example here, let's say you have a self-directed IRA, it doesn't have enough capital, or you don't want to use all of the capital to acquire the real estate. The IRA can actually obtain a special type of loan, a non-recourse loan, where the lender actually loans money to the retirement account. And now the retirement account would pay for the property. The retirement account still pays for expenses, generates returns, and then uses those returns to pay off that non-recourse loan. So typically with non-recourse financing, it's only going to be used for income producing property. The lender wants to make sure that the investment the IRA making is going to generate a return, so that IRA can pay it back and it can pay back that loan. You do need to be careful when you use leverage with a retirement account. It can kick off a tax called UDFI tax, unrelated debt financed income tax. It's a form or derivative of UBIT tax, and it's basically a tax that's applied to the leverage portion. So I'll give you an example. Let's say this IRA had 40% down, and then it used a non-recourse loan to finance the other 60% of this transaction. This IRA account would then buy a property. It starts generating rental income. 40% of that rental income would not be subject to UDFI tax because it was already in the IRA. The other 60%, the leverage portion, it could be subject to UDFI tax. This isn't to deter you from using leverage or a non-recourse loan. Many clients do, but it's just something you need to be aware of. If your IRA incurs this sort of tax, again, it's not paid by you as an individual. It's paid out of the profit that the IRA has generated, and there's a special form, a 990T form, that needs to be filed to pay that tax. With non-recourse loans, you're probably not going to go to your traditional bank to obtain this type of loan. You need to work with a specialized lender. And these non-recourse loans typically require a greater percentage down. So you're not going to be putting 5, 10, 15, 20% down. It may be 30, 40, 50, 60% down. The lender wants to make sure the IRA has some significant skin in the game. And again, it has to be on income producing properties. So if you wanted to buy raw land in the hopes that it appreciates over the next 20 years, probably not the investment that you'll be able to obtain non-recourse financing for. Some of the specialty lenders, we have them listed here, that provide this type of financing. So if this is something you're interested in, circle back with me. I can get these resources out to you. You can reach out to some of these providers and get a better understanding of their terms. Obviously, the particular real estate you're going to be buying is really going to have a large effect on their terms and kind of dictate those terms. So when you talk with these lenders, they can give you their general terms, but if you want to get specifics on a particular project, they're going to want to look at that property, since that's the only collateral for the loan. That lender can't come after you. You're not personally guaranteeing this non-recourse loan at all. The only collateral for these loans is the asset that the IRA is buying. Again, they can't come after you personally if your IRA were to default on a non-recourse loan for whatever reason. Talked a lot about self-directed IRA accounts. I do want to talk about one account for individuals if they qualify. That's a very powerful account. It's our self-directed solo 401k plan. And again, not everyone qualifies for this. To qualify, you have to be a small business owner without any full-time employees other than a business partner, or maybe a spouse or other lineal descendant like kids or grandkids in the business. The benefit of a self-directed solo 401k plan, one of that is larger contribution amounts. Right now, currently for 2022, the max contribution you can make to an IRA if you're under 50 years of age is $6,000. If you're 50 years of age or older, it's going to be $7,000. Next year for 2023, because of inflation, the IRS has increased those limits to $6,500 and $7,500 respectively. But if you're looking to get started with a retirement account, $6,000, $7,000 contributions, that may not be enough to go out and do the types of real estate deals you're looking to get involved in. I always tell clients every account started at zero, so you have to get started somewhere. But if you qualify for a solo 401k plan, they have much larger contribution limits. For 2022, you can contribute up to $20,500 as an employee, plus an additional $40,500 as an employer, for a max of $61,000 if you're under 50 years of age. And the IRS also has a catch-up provision for those 50 years of age and older. You can contribute potentially up to $67,500 to a solo 401k. Again, you have to have a business that's generating taxable income without any full-time employees. If I had 3 or 4 employees working for my business, I would have to set up a group 401k plan. I can't discriminate against those employees. If I'm offering this benefit, this retirement benefit to myself, I'd have to offer it to those eligible employees as well. But in this special scenario, if I'm a sole proprietor or I'm self-employed, I may be the only employee. So I can be very generous, or the business can be very generous with its matching to this 401k plan. And that's really what's allowing you to make those extremely large contributions to the plan. I've worked with a few individuals that maybe haven't been saving for retirement as much as they wanted to in their younger years. They're looking to catch up. If they have a side hustle or a small business, they're self-employed and they qualify for a solo 401k, being able to contribute $61,000, $67,500 could really help kind of jumpstart the growth in that retirement account, maybe help them catch up. And it also allows them to get capital into an account where they can start doing some deals that require a larger amount of capital. In the solo 401k plan, this example, you'll see you as the business owner will adopt or sponsor a solo 401k plan here. You can make contributions to this plan based off of the earned income that you're generating, and you're contributing both as an employee and as an employer. So when I'm contributing as the employee, I can contribute 100% of my income up to $20,500 if I'm under 50. or up to $27,000 if I'm 50 years of age or older. And then the business can make a match on my behalf. So the business or the employer can make up to a 25% contribution of my compensation with a max of $40,500. If you need any help calculating, how much you're able to contribute, we have resources for that. But once you've contributed to the 401k plan, it can now invest in all the same assets we've been talking about. Lending on people's real estate projects, investing in syndications, investing in rental properties. It could even invest in a single member LLC structure or a multi-member LLC structure. Another huge benefit to the solo 401k plan is when it's invested in debt leveraged real estate, like those non-recourse loans we talked about. Solo 401k plans are not subject to UDFI tax. That does not mean they're not subject to UBIT tax. UDFI tax is a derivative of UBIT. And I've heard a few experts say that, solo 401ks, they're not subject to UBIT. That is not an accurate statement. They are not subject to that very specific form based on debt leveraged real estate, that UDFI tax. So that's an important distinction there. I had a client, they had a self-directed IRA, they were investing in rental properties, they were using leverage, they were having to file 990Ts and pay that UDFI tax to the IRS. They also were self-employed. So once they realized they qualified for this account type, they were able to set it up. They moved their assets from their IRA under this plan. Now, any new real estate deals they do with leverage, they don't have to worry about that UDFI tax. So another huge benefit to a solo 401k plan over and above an IRA, the large contribution limits not being subject to UDFI tax. And then the last thing I'll touch on here, there's also a loan provision. So if you have a 401k plan at work, you may be able to borrow personally against that account. With the solo 401k, you can also borrow a personal loan. You can borrow 50% of the plan assets up to a maximum of $50,000. That could be used to go on vacation or whatever other personal reason you may want to take that loan for. When you pay back that loan, you're paying back your own retirement account plus interest. A lot of people see that as a win-win. Rather than borrow from a bank and pay interest to the bank, I can borrow from my retirement account and pay interest to my own retirement account, which is a nice benefit. Here we've got the contribution limits for these solo 401k plans. Again, we've got the 2022 limits. Again, because of inflation, the IRS actually increased these limits for 2023. So if you're interested in the solo 401k plan and want to know those new contribution limits, again, let me know. I'm happy to share that information with you. All right, so we've covered all these different account types. How do you get started with the self-directed account if you're interested? It's really 3 easy steps. You need to open an account, you need to fund that account, and then you need to invest that account. So if you want to get started with opening an account, we've got PDF applications. We also have a program called Nova that we use. It's kind of our e-signature platform. It's where you can safely, securely, provide your information to open a new self-directed account, whether that's an IRA or solo 401k. Our applications, we process those within a single business day, and we send out a welcome email that basically provides you your new account number, links so you can set up online access. You can view your account balances and statements just like you would at a Fidelity or a Schwab, and manage your account through that online portal that we have. So setting up the account, we control that process. We open these accounts very quickly once we have the application and a copy of your photo ID, which again can be uploaded through our system Nova that we use. This is a just quick screenshot of what it looks like if you were to work through Nova to set up an account. You click the red start button, you enter in some basic information, your beneficiaries, and then again, that'll be processed within 24 hours. Once you have your account number and your account's been established, now you can work on the next step, which is funding your account. There's 3 ways to fund an account. You can make a contribution out of pocket if you're eligible. You can also transfer some existing IRA funds from other IRA accounts you have elsewhere, or you could roll over employer plan funds. So maybe you have a 401k through your old employer, or a 403b, a thrift savings plan, a pension plan, those different employer plans. You can potentially roll money over from those plans into your account to get it funded. I will mention this step we do not control. It's that current financial institution where your money's at. that's going to dictate how quickly this happens. If you're transferring funds
and
for an IRA,
they don't want to lose your money, so don't expect that to happen overnight. So if that's from my understanding, if that's something you're looking to do, get started sooner than later, because they are going to drag their feet, because every day they hold your money, that's more money that they're making, right? So
exactly
get
right.
started with that sooner than later.
Yes, I've had a few clients that, we've talked about self-directed accounts. They love the concept, but they never set up their account or got their rollover initiated from their old employer 401k or their transfer initiated. They come to me and say, okay, Jeff, I found a great property. It's a great fit for the IRA, and I need to get started. Oh, by the way, we're closing next week on Tuesday. That's not a time frame that you want to be putting yourself under to try to make that happen. So absolutely, like Dallin mentioned, moving this money, it's not Venmo, it's not Cash App, it's not instantaneous. Moving qualified funds, it takes a little bit longer. I'll give you an example. We have a client. They were rolling over funds from an old employer 401k. Rollovers, they're checks going through the mail. So the check has to get issued, payable to your account here. It gets mailed to us. Once we receive it, we have to deposit it, and that check has to clear before that money would be available for an investment. So I always tell clients, you want to give yourself a little leeway time here to get your account not just open, but also funded. And you really want to babysit this process. As Dallin mentioned, these companies, they're not looking to move funds out. That's how they make money. That's how they charge fees. So you really have to kind of babysit this process. And if you need an update on where this process is at, you really want to reach out to that current financial institution. If you call us and ask if the money has arrived, we can either say yes or no, and that's about it. If you called your IRA custodian or your 401k plan administrator, you're the account owner, they will share information with you that they will not share with us. So they will gladly verify your information and then tell you exactly where they're at, in the process. Maybe the check has been cut and it's been mailed out. Maybe it's still in process. But if we try to follow up on that for you, they don't want to share information about your account. Those companies are trying to protect against fraud. So always a good idea to make sure that you're not just contacting them to make sure you're following their procedures correctly, but then you follow up on it even afterwards to make sure they're doing what they said they would do and they're doing it quickly and efficiently. Again, these timeframes can vary drastically because there's no standard process here. Every company processes their transfer out or their rollover out a little bit differently.
And just to clarify, that the time is tied up in the rollover. Once it's in your self-directed IRA and you have that checkbook control, you can write checks same day. So
exactly.
So the key is to get it in, get it set up, get it into that account. So if somebody does present a syndication opportunity or a passive investment opportunity next week, you're ready to go.
That's exactly right.
And Jeff, just so you're aware, we got about 3 or 4 minutes left, and we got a couple questions we want to touch on as well.
Perfect. Well, this will be easy. Once your account's funded, you can invest. We have direction of investment forms that you fill out. Basically tells us what asset you're investing into. Maybe it's investing in a syndication directly through the account. Maybe it's sending money to that IRA LLC that you've set up so you now have checkbook control over the account. But we process those investments within 3 business days. We really just want to make sure the investment titling is correct. Again, in the name of the IRA, not in your personal name, and that we have any supporting documents we need to keep on file. So again, open your account as soon as possible if you're interested, fund it as soon as it's established, because those timeframes vary. That way you can ensure you have funds available when you're ready to make an investment opportunity. Our pricing, if you were setting up a self-directed IRA, we typically charge a one-time account establishment fee of $50 and an annual fee of $295. It's a flat annual fee, regardless of account value or regardless of the number of investments you hold. So that's somewhat unique in our industry, having that flat annual fee, very straightforward. When you make an investment, we have a one-time $50 investment processing fee. As a benefit for being on this webinar and participating today, we do have a promotion code we want to extend. Now, this promotion code, it will expire at the end of the month, so it's really encouraging you to take action now if this is something you're interested in. When you set up your account, just type in the promo code REV150. We'll take $150 off your first year fees. And again, if you need help opening an account, let me know. On our website, you can actually schedule appointments with me. I'll also share my contact information here below. So reach out to me directly. I'd be happy to help.
Excellent, Jeff. Man, this is so much information. It's a ton of information, and when you're learning about these different vehicles and this aspect of investing, it's easy to feel extremely overwhelmed. So the purpose of this webinar and the purpose of this presentation that Jeff presented was to give you an introduction, to give you an idea, just to be aware of what's available to you. Now, you don't need to know all of it. As long as you're aware of it, reach out to Jeff. There's experts in this space to help you and hold your hand and walk you through this process. The important thing that I'm hoping you get from this webinar today is just becoming aware. Again, you don't know what you don't know. So I just want you to be aware of these additional vehicles. So Jeff, excellent. Thank you so much. We do have a couple questions here. So the first one was posed just prior, before you talked a little bit about UBIT tax, but I wanted to follow up on that a little bit. So they asked, can you please talk about UBIT and what if anything can be done to reduce it with any passive losses? So some people will invest with a self-directed IRA and they will get hit with that UDFI tax. So what are some, and maybe this is more of a CPA question, but in your experience, what have been some things that you've seen to help benefit people?
Yeah, I would say, it's important to remember UBIT tax or UDFI tax. It's not a tax that you're personally paying. It's a tax that the IRA has to pay. So it's based on, the IRA generating profit. If the IRA doesn't generate a return, then it may, UBIT tax may not apply. There's even an exemption for the first $1,000 of profit that's generated. So it's really going to be dictated on the amount of profit that's generated back to the IRA from that investment. And there's a graduated tiered scale. Great conversation, as you mentioned, have with the CPA or tax professional to kind of determine, what that UBIT tax amount is, and then file the appropriate forms to pay for it. But we have clients investing in syndications. Those syndications may have losses to help offset. So you may not generate, returns on your investment back to your IRA for several years. So you may not incur any UBIT tax, let's say, for several years until you're generating, net profit back to your retirement account. I will say there's no way to write off depreciation, in an IRA account. That doesn't apply. So you're really looking at it through a different lens. You're looking at the profit generated from the rental income of the proceeds of the sale, no capital gains tax, no 1031 exchanges. Those are really the benefits. But if you do incur UBIT, it is always best work with the CPA or tax professional to be able to calculate what that amount is, and then make sure you're filing the appropriate 990T and paying for that.
And if that's something you want to try to avoid completely, at least on the UDFI, then talk to Jeff, see if you qualify for that solo 401k, because that plan is not subject to that. So last question to wrap it up. Abraham, I might have you expand a little bit on this. I apologize. This probably would have been more appropriate to plug in at that time. So his question was, will that contribution be deducted from your gross income and be a tax deduction on both personal and business if matched? I believe this is back when we were talking about the matching, right, with the solo 401k. Is that correct, Abraham? Okay.
Yeah, I see Abraham shaking his head. So yeah, when you're contributing as an employee, think about that's coming almost from your checking account, your personal checking account. I'm contributing as an employee. When I'm contributing as an employee, I can either contribute tax deferred into a traditional component of the plan or after tax to a Roth component. So if I'm contributing after tax, I'm not going to receive any deduction or write off for that. If I'm contributing to a traditional component, tax deferred, I may or may not. It really just depends on your income. So again, great conversation to have with your accountant or your CPA to help determine, do you personally, are you able to write that off at all? The employer contribution, that's coming from the business. So that's an expense to the business. So the business may be able to deduct that. But again, when it comes to those solo 401k contributions, everyone's income and those sources, it can be different. So it's hard to say, one size fits all, but Is there potential for a deduction or a write-off? Yes, but consult with your CPA or tax professional to make sure.
Excellent, Jeff. Now, there's been a lot of deferring to CPAs. I guess my general question is this common knowledge for most CPAs? And the reason I ask is because in the real estate world, in the syndication space, a lot of CPAs aren't familiar with all the benefits of the real estate, how the tax code benefits real estate. So when it comes to these self-directed IRAs and solo 401ks, is that more common knowledge among CPAs, or are there ones that specialize more so in that space?
I would say for your questions about contributing to these retirement plans, that's common knowledge. Is it deductible or not? Most CPAs are aware of IRA accounts, solo 401k accounts, those contributions, how that works. Once you're making investments into alternative assets like real estate, filing a 1065 for your multi-member IRA LLC or a 990T, that's a bit more specialized. And we do have great resources for that. If you go to our website, we have a resources page. You'll see we have different CPA firms listed there. And that's something that we get questions on quite a bit. I've started a self-directed account. I talked to my CPA. They have no idea. They're looking at me sideways. They're not sure what I'm doing. Okay, you want to work with a CPA that understands, exactly what a self-directed IRA is and how to utilize it, the tax benefits it can generate. So if you need help finding a new CPA to work with, we have some great resources that we can refer you to. And I know that's something, our founders are working on, is actually building out a larger network of CPAs, because it's a common question that we get.
Awesome. Thanks, Jeff. Abraham, did that answer your question all right?
Yes, thank you both for hosting this today.
Hey, not a problem. Our pleasure. Jeff, thank you so much. This is a wealth of information. Greatly appreciate your time. What's the best way for people to get a hold of you if they have additional questions?
Yeah, so I'll go ahead and put my contact information in the chat so you have that. I'll give my direct number out. You can always call me. And then also I'll send you my email address. Email's great. Shoot me a quick email. I can send you my contact information and also a link to schedule an appointment with me. If you go to our website too, there's a place there where you can actually, in the upper right-hand corner, schedule an appointment with one of the representatives here. I'm listed there as well. So a number of different ways to get in contact with me, but I'll make sure to include that here in the chat. And then also, Dalen, I'll share out my slide deck as a PDF document, so that can be dispersed too for anyone that's interested.
Excellent. And if this is your first time with us, we do record these webinars and we send them out every Tuesday morning with that week's webinar announcement. So this upcoming Tuesday, you'll receive an email if you've registered for the upcoming webinar and the guest speaker or whatever topic we're talking on. If you scroll down, there will be access to this recording. What we'll also do is include the PDF of this presentation. As you can see, there's a lot of diagrams. And so being able to understand this process can be crucial. So we'll include that along with Jeff's contact information if you're unable to grab it here in just a minute. So it looks like he's putting it in right now.
That's right. Well, thank you so much again, Dalen, for having me on. I know it was a ton of information to kind of cover very quickly there. So thank you for bearing with me and letting me speak that whole time. If you guys do have some more specific questions, happy to be a resource for you. So just let me know when I can be of further help. Excellent.
Thanks a lot, Jeff. Well, folks, appreciate your time. Thanks for sticking it out for an extra 7 to 8 minutes with us. So a lot of great information, and appreciate you taking time out of your day to learn a little bit more about real estate and ways that you can benefit yourself or even your investors if you're active in the space as well. So it was a pleasure meeting you. And Jeff, again, thanks so much for your time. And folks, hope to see you next week. Thanks for coming out.